Imagine your income disappears on Monday. 2 weeks later, your car needs an $1,800 repair. Your health insurance deductible is higher than expected. Your landlord announces a rent increase. And your investments are down, right when you need money. Could your finances survive that year without turning one emergency into years of debt? That is the ultimate financial stress test. And the first answer is simple. Financial survival depends less on having an impressive net worth and more on having cash, manageable bills, useful insurance, and enough flexibility to make decisions under pressure. This matters because financial problems rarely arrive one at a time. A car repair is annoying. A car repair during a job loss is dangerous. A market decline may be temporary. A market decline when you are forced to sell investments can make the loss permanent. According to the Federal Reserve's 2025 Household Survey, released in May 2026, 59% of adults experienced at least one major unexpected expense during the previous year. Only 55% said they had emergency savings covering 3 months of expenses. 30% said they could not cover 3 months by using savings, borrowing, or selling assets. So let's build a practical 6-part test for a bad year. Not to predict every disaster, but to find the weak points before something breaks. Start with cash runway. Suppose Maya brings home $5,000 a month. Her essential bills are $3,700. That includes housing, basic utilities, groceries, transportation, insurance, minimum debt payments, and necessary medical costs. Her survival number is not $5,000, it is $3,700. That distinction matters. 3 months of essential expenses would be $11,100. Now imagine Maya loses her income for 2 months and has an $1,800 car repair. That creates $9,200 of immediate pressure. With an $11,100 emergency fund, she can cover it and still have $1,900 left. It would be uncomfortable, but she would have time to look for work without immediately borrowing at a high interest rate. If she had saved only 1 month of essential expenses, she would face a $5,500 gap. Put that gap on a credit card charging 24% annual interest, and the first month's interest alone would be about $110. If the balance remains near that level for a year, the interest approaches $1,300. The original emergency was temporary. The resulting debt may not be. This is why an emergency fund is not just money for emergencies. It is money that prevents emergencies from choosing your next financial move. Investor.gov describes emergency savings as money kept somewhere safe and accessible, such as an insured bank or credit union account. It also acknowledges the trade-off. Cash may earn less than long-term investments and can lose purchasing power to inflation. Its job, however, is immediate availability rather than maximum growth. If you enjoy practical explanations that make money decisions easier to see, consider subscribing. Now, let's move to the part of the test that people often miss. The second test is fixed cost pressure. 2 households can earn the same income and have completely different levels of resilience. One may need 55% of its take-home pay for essential bills. The other may need 90%. The second household does not necessarily have a spending discipline problem. It may live in a more expensive area, support children, need a car for work, or face high medical costs. But the mathematical result is the same. Less monthly margin means shocks arrive faster than savings can recover. Ask what could actually be reduced within 30 days of losing income. Canceling entertainment subscriptions may help, but it probably will not transform the budget. Housing, transportation, insurance, and minimum debt payments are usually the heavy pieces. A resilient budget, therefore, has 2 versions. There is the normal budget, and there is the emergency budget. The emergency version answers a specific question. What would it cost to keep the household safe, housed, insured, fed, and mobile for the next 90 days? The third test is insurance exposure. Insurance transfers certain large risks in exchange for a predictable premium. But having insurance does not mean an emergency costs nothing. Deductibles, co-payments, waiting periods, coverage limits, and exclusions can still create a cash demand. A useful stress test is to identify the largest amount you might reasonably need before coverage takes over. That could be a health insurance deductible, a car insurance deductible, or the cost of replacing essential belongings after a covered event. Then compare that number with your liquid savings. A policy may protect your long-term finances from a huge loss, while still requiring several $1,000s today. Insurance and emergency savings work together. They do not replace each other. The fourth test is high-interest debt. Debt changes how quickly a bad year spreads. Without debt, a job loss reduces income. With expensive revolving debt, the same job loss reduces income, while interest continues increasing the amount owed. This creates a difficult question. Should you build emergency savings or pay off the debt first? There is no universal percentage that solves this for everyone, but the trade-off becomes clearer when you separate protection from optimization. Keeping no cash while paying debt aggressively can leave you borrowing again after the next repair. Keeping a huge cash balance while expensive debt compounds can also be costly. A middle path is often easier to understand. Build a starter buffer for common shocks, keep making required payments, and then direct more money toward the highest cost debt. As that debt falls, expand the emergency fund toward the amount your actual risks require. The key is to avoid treating a credit limit as an emergency fund. Available credit can be reduced by the lender, and borrowing becomes more expensive precisely when income is already under pressure. The fifth test is liquidity. Liquidity means how quickly an asset can become spendable money without a large penalty or loss. $10,000 in a savings account and $10,000 in a stock fund may look identical on a net worth statement. They are not identical during an emergency. The stock fund might be worth $7,500 during a market drawdown. Selling then locks in the decline. A retirement account may involve taxes, restrictions, or penalties, depending on the account and circumstances. Home equity may be valuable, but difficult to access quickly. This leads to an important correction. A falling market is not automatically a personal financial emergency. The danger appears when a separate emergency forces you to sell volatile assets at a bad time. Investor.gov defines investment risk partly through uncertainty and potential financial loss. It also identifies liquidity risk as the possibility that money cannot be accessed when needed without difficulty or cost. Your short-term survival money and long-term growth money have different jobs. Mixing those jobs can make both plans weaker. The sixth and final test is income flexibility. Most financial plans focus on how much money is saved. Fewer consider how quickly income could recover. If your main paycheck disappeared, how long would it realistically take to replace it? Could you increase hours, take contract work, use a professional license, sell a service, or temporarily accept a different role? Are there two incomes in the household, and are they exposed to the same industry? Income flexibility does not mean every hobby needs to become a side hustle. It means understanding whether your entire financial system depends on one employer, one client, one physical ability, or one highly specialized role. Now, combine all 6 tests into one 90-day scenario. Assume your primary income stops today. Your investments fall 25%. A necessary repair costs $2,000. One monthly bill rises by $200. Insurance covers the catastrophic risks, but you must pay the deductible first. Can your liquid savings cover essential expenses and the deductible? Can your emergency budget reduce the monthly burn rate? Do debt payments keep accumulating? Can you avoid selling long-term investments? And how quickly could some income restart? If the answer is yes across most of those questions, your finances may be more resilient than your net worth suggests. If the answer is no, that is not a verdict on your character. It is a map. Maybe the first weakness is a missing starter emergency fund. Maybe it is a car payment that leaves no monthly margin. Maybe it is an uninsured risk, expensive credit card debt, or too much money locked in assets that cannot safely pay next month's rent. One common mistake is waiting until you can build the perfect 6-month fund. 6 months is a useful reference point, not a law. A renter with stable employment, low fixed costs, and 2 household incomes may face different risks from a self-employed homeowner supporting a family on 1 variable income. Start with the emergencies most likely to happen. Then work toward the emergencies that would do the most damage. The goal is not to keep so much cash that you never invest. Cash has inflation risk, while long-term investing involves market risk. The goal is to give each dollar a job based on when it may be needed. A strong financial plan is not one that looks perfect during a normal month. It is one that preserves choices during an abnormal year. That is what surviving a bad year really means. Not avoiding every loss, not keeping every investment untouched. It means having enough time, liquidity, protection, and flexibility to prevent one setback from controlling the next several years of your life. Which part of this stress test feels most difficult right now? Emergency savings, fixed costs, insurance, debt, liquidity, or income flexibility? Share your questions in the comments and suggest the next money topic you want explained.